Imagine you're paying $2,500 every month for a place to live, and you're starting to wonder, am I throwing that money away, or am I making the smarter financial choice? Now imagine the alternative is a $2,500 mortgage. It sounds obvious. Buy the house, build equity, become a homeowner. But in America, that simple comparison can hide thousands of dollars in costs. And sometimes, the cheaper-looking option is actually the more expensive one. My name is Polly, and today we're going to look at the real buy versus rent decision. Not as a debate between homeowners and renters, but as a question about what happens to your money, your lifestyle, and your future. Let's start with the number most people notice first, the monthly payment. Suppose you can rent a decent home or apartment for $2,500 a month. Then you find a house where the mortgage payment appears to be around $2,500. At first glance, buying looks like the obvious winner. After all, part of that mortgage payment can build equity. Rent doesn't give you an ownership stake, but the mortgage payment is not the same thing as the cost of owning a home. Property taxes can add hundreds of dollars a month. Homeowners insurance adds more. If you put down less than 20%, mortgage insurance may enter the picture. Then there's maintenance, repairs, appliances, landscaping, utilities that may be higher, and the occasional bill that arrives at exactly the wrong time. A roof does not care that you had a great month at work. A broken water heater does not care that you were planning a vacation. And a property tax bill definitely does not care that your grocery bill just went up. Renting has its own costs, of course, but one major advantage is predictability. Depending on the lease and market, you may know roughly what your housing expense will be for the next year. If the air conditioner dies, you generally call the landlord. If the roof needs replacement, that is usually not your personal financial emergency. That difference matters because money is not only about the total amount you spend. It is also about how much financial flexibility you have left after the bills are paid. Now let's make the comparison more realistic. Imagine a $400,000 house. Suppose you put 20% down, which is $80,000, and finance the remaining $320,000. Your mortgage payment depends on the interest rate and loan terms, but even if the principal and interest payment looks manageable, you still need to add taxes, insurance, and maintenance. And that $80,000 down payment is not just a number on a spreadsheet. It is money that could otherwise remain invested, stay in an emergency fund, or help you build a business. Once you put it into the house, it becomes home equity. That can be valuable, but it is not the same as cash sitting in your brokerage account. This is one of the biggest mistakes people make when comparing buying and renting. They compare rent to the mortgage payment. A better comparison is rent versus the total economic cost of owning. That means you should think about interest, taxes, insurance, maintenance, transaction costs, and the opportunity cost of your down payment. And there is another cost people rarely talk about: moving. If you rent and decide your job is no longer right for you, moving to another city can be inconvenient, but it may be relatively straightforward. If you own a house, moving can become a financial project. You may have realtor commissions, closing costs, repairs before selling, moving expenses, and the risk that the home does not sell as quickly as you expected. That is why the length of time you expect to stay matters so much. If you buy a house and sell it after a short period, the transaction costs can eat into your equity. Renting can be surprisingly competitive when you value flexibility. But if you plan to stay in the same home for a long time, the math can change. With a fixed-rate mortgage, your principal and interest payment can remain stable while rents in the surrounding market rise. Over time, inflation can make that fixed payment feel smaller relative to your income, and every mortgage payment that reduces your principal can increase your equity. That is the part of homeownership that makes buying attractive. But there is a catch. Equity growth is not the same as investment return. If you buy a $400,000 house and the property eventually becomes worth $500,000, you have gained value on the home, assuming you still own it and ignoring selling costs and other expenses. But you also paid interest, taxes, insurance, maintenance, and other ownership costs along the way. The house can be a powerful wealth-building tool, but it is not a magical investment machine. And this is where your personal situation becomes more important than any universal rule. If you have a stable job, a healthy emergency fund, manageable debt, and you expect to stay in one area for a long time, buying may fit your life extremely well. You get control over the property. You can renovate it. You can make the space your own. You can build equity. And eventually, if you pay off the mortgage, you can eliminate one of the biggest monthly expenses most households face. But if your career is changing, you may want flexibility. Maybe you're 28 and your company could move you across the country. Maybe you're building a business and need capital. Maybe you're not sure whether you want to live in the same city for 5 years. Or maybe buying the house would drain almost all of your savings. In those situations, renting can be a financially intelligent choice, not a failure to build wealth. That last point is important. Renting is often treated like throwing money away, but you are not paying rent only for a roof. You are paying for housing, flexibility, and the ability to transfer many maintenance risks to someone else. The real question is, what are you doing with the money you are not putting into homeownership? Because this changes the entire comparison. Imagine two people. Person A buys a home and spends nearly every dollar available on the property. Person B rents a similar place for less, invests the difference consistently, maintains a strong emergency fund, and keeps flexibility to pursue higher-paying work. After 10 or 15 years, who is wealthier? You cannot answer that from the rent versus mortgage number alone. You have to look at the complete financial picture. This is also where lifestyle enters the equation. A house can give you more than financial value. Maybe you want a backyard for your kids. Maybe you want a home office. Maybe you want to renovate a kitchen. Maybe you want stability because moving every year is exhausting. Those benefits have real value, even if they do not appear on a balance sheet. On the other hand, renting can provide lifestyle benefits too. You might live closer to work and cut your commute. You might live downtown without taking on a huge mortgage. You might be able to travel more easily. You might have less responsibility for repairs. You might be able to move when an opportunity appears. So the smartest choice is not necessarily the one that produces the lowest housing payment. It is the choice that supports the life you are actually trying to build. Now let's talk about the interest rate problem. When mortgage rates are high, buying becomes more expensive because a larger share of your early payments can go toward interest. That does not automatically mean buying is wrong. It means the purchase price, loan amount, down payment, and expected holding period become even more important. And you should never build a household budget around the assumption that you can refinance later. Maybe rates fall. Maybe they do not. A refinance should be treated as a possible future opportunity, not as the reason today's payment is affordable. The same discipline applies to home appreciation. Do not buy a house because someone tells you real estate always goes up. Real estate markets can rise, stagnate, or decline. Different neighborhoods can behave very differently. A home should first make sense as a place you can comfortably afford to live. Any appreciation is a potential benefit, not a guaranteed outcome. There is another number you should calculate before buying, your true monthly housing cost. Take the mortgage principal and interest. Add property taxes. Add homeowners insurance. Add an estimated maintenance reserve. Add mortgage insurance if applicable. Then consider utilities and any association fees. Now compare that total with rent. That is already much more useful than comparing rent to the mortgage alone. But we can go one step further. Ask what your down payment could earn if it stayed invested. You do not need to assume a specific guaranteed return. You can model several hypothetical scenarios. For example, if you have $80,000 available for a down payment, you could compare a home purchase with a rental strategy that keeps some or all of that capital invested. The purpose is not to prove that stocks always beat real estate. They do not have to. The purpose is to understand the trade-off. Every dollar has an opportunity cost. Money placed into a house cannot simultaneously be used for something else, and that is the heart of the buy versus rent decision. It is not really about whether renting is good or buying is good. It is about which use of your money creates the strongest combination of financial security, flexibility, and lifestyle value for you. Now imagine a family earning $120,000 a year. They could technically qualify for a much larger mortgage than they should comfortably carry. A lender may focus on whether the payment fits certain underwriting rules. But your family should ask a different question. After housing, taxes, groceries, transportation, insurance, childcare, retirement contributions, and everything else. How much breathing room is left? Because a house you can technically afford can still make you feel broke. That is lifestyle inflation wearing a mortgage. And it can be especially dangerous because the expense is difficult to reverse. You can cancel a streaming service. You can reduce restaurant spending. You can sell a car. Selling a house is a completely different process. This is why the strongest home buying decision often starts with a boring number: your comfort level. Not the maximum a bank will approve. Not the maximum your friends say you can handle. Your number. The payment that lets you sleep at night, keep investing, maintain an emergency fund, and still enjoy your life. And if that number points toward renting, there is nothing financially embarrassing about it. In fact, renting can be a strategic phase. You can use those years to increase your income, eliminate high-interest debt, build a down payment, invest, and learn which neighborhood actually fits your family. Then, when you buy, you are not buying because you are afraid of missing out. You are buying because the numbers in your life finally line up. So, which is actually cheaper in America, buying or renting? The honest answer is that there is no universal winner. Buying can become financially powerful when you stay for many years, keep the total cost manageable, and value the stability and equity that ownership provides. Renting can win when flexibility matters, when comparable rent is substantially cheaper, when you may move soon, or when buying would consume too much of your capital. And there is one final mistake I want you to avoid. Do not make the decision based on what other people are doing. Your coworker buying a house does not know your financial goals. Your friend renting a luxury apartment does not know your future. Your parents may have bought a house at a completely different price-to-income ratio, and social media definitely does not know your budget. The right housing decision is personal. If you are considering buying, calculate the total cost. Stress test the budget. Keep an emergency fund. Think about how long you will stay. Consider what else your down payment could do. And make sure the home fits your life, not just your ego. If you are renting, do the opposite of what people assume renters do. Do not simply spend the difference. Use the flexibility. Invest consistently. Build your emergency fund. Increase your income. Keep your fixed expenses under control. Turn the capital you did not put into a house into another form of wealth. Because the goal was never to own a house just so you could say you own a house. The goal is to build a life where your money gives you more choices. Maybe that eventually means a paid-off home. Maybe it means a portfolio large enough to work for you. Maybe it means a business. Maybe it means the freedom to take a lower-stress job, travel with your family, or stop worrying about every unexpected bill. The house is a tool. Rent is a tool. Investing is a tool. Your job is to decide which tools help you build the life you actually want. So before you sign a mortgage or renew another lease, forget the argument about whether buying is always smarter. Pull out the real numbers. Look at the total cost. Look at your timeline. Look at your opportunity cost. Look at your family. And then ask the question that matters most. Which choice leaves you with the strongest financial life? Not just the most impressive address. That is the real buy versus rent decision. And there is a practical way to make this decision less emotional. Create 2 5-year scenarios. In the first, you buy. Estimate the purchase price, down payment, loan, taxes, insurance, maintenance, and expected selling costs. Then estimate how much principal you might have paid down. Do not assume appreciation is guaranteed. Run a conservative case, a middle case, and a flat price case. In the second, you rent. Estimate rent increases, renter's insurance, and your other housing costs. Then calculate what happens if you invest the difference and keep the down payment invested instead of putting it into the property. Now compare the two outcomes. You may discover that buying wins financially. You may discover that renting wins. Or you may discover that the difference is much smaller than you expected. That last result is important because it means your lifestyle preference can legitimately break the tie. If owning gives you stability, privacy, and a place your family loves, that value matters. If renting gives you mobility, lower responsibility, and the ability to chase better opportunities, that matters too. There is no trophy for choosing the more expensive option. There is only the life you eventually have to live with. So make the decision with numbers first, Then use your values to finish it. Because the best home is not necessarily the one with the biggest kitchen, the nicest driveway, or the highest price tag. It is the one that fits your finances so well that you can enjoy living there without constantly worrying about how to afford it. And if renting gives you that freedom today, use it wisely. If buying gives you that freedom for the next decade, buy responsibly. Either way, your housing decision should serve your wealth, not quietly consume it. The winning move is not simply getting the keys. It is keeping enough cash, flexibility, and investing power that one housing decision does not control your entire financial future. When your home supports your money goals instead of competing with them, you have created something more valuable than ownership: genuine financial breathing room and freedom.